Now, more recently, the news narrative has switched to jobs or the lack thereof, and that's because the US Federal Reserve has two objectives: one, to promote maximum employment, and two, stable prices. Can you imagine those being your goals and having tariffs come into the mix out of nowhere, and then have a government shutdown affect the reporting of unemployment? And oh, yeah, the government literally being shut down means people aren't working or working and not getting paid. Unreal. The Fed does these two things through a number of ways, but the most obvious one is by raising or lowering interest rates. This effectively gives them the power to speed up or slow down the economy. The rate that they set is known as the federal funds rate, or how expensive it is to borrow money at a base level. Now, people like you and I, who borrow from banks for cars, homes, or take out personal loans, start our rates from something called the prime rate. This is the rate lenders set for the most qualified borrowers, which is usually the federal funds rate plus a few points of interest, so the lender gets a little off the top. And then rates go up from there if you're not an ideal borrower. So, how did we get to today's inflation and job situation? This didn't feel like a very drastic issue until recently. Well, back in 2022, things happened. The Fed dropped rates to basically zero, and they moved tons of money into the system. All gas, no brakes. It's like they watched a Fast and Furious movie over the weekend and ignored all the warning signs on the screen. So, with all this cash around at basically no expense, asset prices inflated. This also led to a cost of living issue because with all this cash came increasing costs passed on to consumers. And generally speaking, wages have not kept up with the rise in costs. That's basically the past 5 years in a nutshell.